All right, so this week we found a couple of really solid companies. On Monday, we reviewed Hyliion, roughly $4 stock attempting to commercialize a completely different way of generating power with its KARNO generator. We asked one question: could Hyliion eventually become a 10x stock? And then on Wednesday, we went back inside the AI factory and we looked at Eaton, Powell Industries, and Invent to determine which company was best positioned around one of the next major constraints in AI infrastructure. And Powell won with a 9 out of 10 rating. So now we've got two companies sitting in front of me. One's the winner of our AI factory competition, and the other is highly speculative company that could potentially have enormous upside if its technology succeeds. But there's just one problem. I haven't bought either one. And that's because finding an interesting company isn't the same thing as finding an investment. Powell can be a fantastic business, and I can still pay too much for the stock. And Hyliion can potentially become a 10x business as well, and still have such a high probability of failure that it doesn't deserve my money. So that's what this Friday series is all about. And welcome to Fund Hunt, or Friday Fund Hunt. Monday is where we're going to hunt for stocks with potentially extraordinary upside. Wednesday is where we're going to continue building the AI factory and find the company's best position around AI's biggest constraints. But Friday is going to be different. Friday is where those companies have to compete for actual capital. And I'm starting with a hypothetical portfolio. And we're going to start with $100,000 of hypothetical money. Powell is trading around $198.11, and Hyliion is around $3.75 today. But they're not just competing against each other. They're competing against the third option, and that's going to be cash, because there's absolutely nothing in the rules that says that I got to buy either one. And that's going to be one of the most important rules of Friday Fund Hunt. Winning gets you into the fund hunt, and it doesn't get you into the fund. And now we got to determine whether either company actually deserves our money. So before we determine what we're going to buy, we got to establish some rules, because I don't want this portfolio to turn into, I made a video about this company, I liked it, so I bought it. That's not portfolio management. So we're going to start Fund Hunt with a hypothetical $100,000. And every company that makes it through Monday Stock Hunt or wins an AI factory competition can potentially earn the right to compete for some of that money. But we're going to divide investments into three categories. And the first is core position, where these are established businesses where I have high conviction in the company, its financial strength, and its long-term opportunity. A core position could eventually represent roughly 5 to 10% of the fund. With a $100,000 portfolio, that's potentially 5 to 10 grand. The second category is going to be growth. These are companies where I see upside, but maybe we're accepting more valuation risk, more volatility, or more uncertainty. Those positions would generally start around 3 to 5% of the portfolio. And then there's a third category, and that's going to be the speculative stocks. This is where something like Hyliion could potentially fit. These are companies where the upside can be enormous, but the probability of the failure is also much higher. A speculative position would generally be somewhere around 0.5% to 2% of the portfolio. And there's an important reason for that. Imagine I believe Hyliion could eventually go from roughly $4 to $40. That's potentially much more upside than I would expect from Powell. But that doesn't mean I should put more money into Hyliion, because Hyliion isn't the same thing as probability. If I put 1% of a $100,000 portfolio into a speculative company, that's going to be $1,000. And if that investment fails completely, then it's painful, but the portfolio is going to survive. And if the company eventually becomes a 10x, then that becomes $10,000 from that $1,000. And that's asymmetric risk. And that's exactly what I want Fund Hunt to capture. We're not trying to eliminate risk. We're trying to make sure we're being paid enough to take it, which brings us to another rule. Every company has to beat our required return. For an established core growth company, I'm looking for a credible path towards roughly 15% or better annualized returns over the next several years before I'm interested in committing meaningful capital. For a speculative company, I need substantially more upside because I'm accepting substantially more risk. And finally, every company has to compete against what may be the most underrated investment in the entire portfolio, and that's doing nothing. Cash doesn't have a revolution. Cash doesn't have a revolutionary generator. Cash isn't building electrical infrastructure for massive data centers. It's not going to 10x, but cash also gives us the ability to wait until the price and opportunity makes sense. So here's today's competition. It's going to be Powell versus Hyliion, or keep the money in cash. And now we're going to start with Powell, because Wednesday we answered whether Powell was good enough to win the AI factory, but we didn't answer the question that matters today. Is Powell good enough to buy at $198? So first there's POWL, or POWL, stock ticker. I'm going to try very hard not to repeat Wednesday's video, as we already spent an entire episode looking at what POWL does, where it fits inside the AI factory, and how it compares with Eaton and Invent, and why it ultimately earned a 9.0 out of 10 factory score. And if you haven't seen that video, go back and watch that video. It's very interesting between the three companies. That research is what got POWL here, the 9.0 out of 10. Now I want to know whether I should actually buy the stock. And as I'm recording this, POWL's trading at around $198 a share. And that's where the conversation changes, because Fun Hunt doesn't care that POWL won last Wednesday. It cares about what I'm getting for $198. And POWL isn't some undiscovered little company trading at a bargain valuation. The market's noticed what's happening here, and the company has been growing. Its backlog has grown dramatically, and it has a significant exposure to electrical infrastructure. And investors have increasingly connected that opportunity with the enormous amount of infrastructure that has to be built around AI and data centers. So I'm not asking, is Powell a good company? I think we already established that. I'm asking how much of that good news I'm already paying for. And that's one of the biggest differences between AI Factory and Fun Hunt. In AI Factory, I can give a company a very high score because I think it's extraordinarily well positioned. But in the fund, I don't get to buy a company. I have to buy a stock at a specific price. And at roughly 198, Powell's evaluation is not cheap. Depending on whether we're looking at trailing earnings or forward estimates, we're talking about a stock carrying a substantial earnings multiple. That earnings multiple is around 50. And that's not automatically a problem, because I'm willing to pay a premium for a company if the growth justifies it. The higher the valuation gets, the more future success I'm paying for today. And think about it this way: if Powell were trading at 10 times earnings, with the balance sheet, this backlog, with this balance sheet and this backlog and this opportunity, then this would probably be a very short video, but it's not. And the market already expects Powell to perform. That creates a different type of risk. Not necessarily that Powell's business collapse. The risk could simply be that Powell does well, but not well enough. So how much of the growth is already priced in? Revenue could continue growing and the company could remain profitable. Data center demand could remain strong, and the stock could disappoint if investors decide the earnings multiple should come down. And that's called multiple compression. And it's one of the easiest risks to overlook when you're investing in a company with a great story. You can be right about the business and you can be wrong about the stock. And so Powell has passed the first test. And I like the business, I like the financial strength, and I like its positioning. But at 198, I need one more thing, and I need enough future earnings growth to produce the return that we're demanding from this fund. And remember the first rule in chapter 2. For an established company taking a meaningful percentage of this portfolio, I want a credible path towards approximately 15% annualized returns over the next several years. So let's see what Powell would actually have to do to get us there. So I'm not going to pretend to know where the stock price is going to be in 3 years, as nobody knows. But instead, I want to build a range of outcomes and then ask whether buying at $198 gives us enough potential return relative to the downside. So let's start with the bear case. Imagine the AI infrastructure build out continues and Powell does not capture as much as investors currently expect. Maybe some large projects get pushed out. Maybe margins normalize. Maybe orders remain healthy, but the extraordinary growth in backlog slows. Or maybe absolutely nothing catastrophic catastrophic happens and investors simply stop paying such a high multiple for the company's earnings. In that environment, I could see Powell falling somewhere into the roughly $150 to $175 range. And again, that's not a price target, it's a scenario. From $198, that would represent meaningful downside. That's not exactly why I'm not willing to say Powell won the AI factory, so buy it. There's real valuation risk here. Now let's move to the base case. This is where Powell continues doing what we need to do. And the backlog converts into revenue. Earnings continue to grow. Data centers become increasingly meaningful part of the business, and the company's other industrial and energy markets remain healthy. And Powell continues earning a premium valuation because the market sees it as one of the beneficiaries of this enormous electrical infrastructure build out. Under that type of scenario, I think in the neighborhood of 275 to 325 over the next several years becomes reasonable to investigate. Let's use $300 just to make the math easy. Going from 198 to 300 sounds pretty good. That's a gain of roughly 51%. The fun hunt forces us to ask another question. How long does that take? And if Powell reaches 300 in 3 years, that's roughly 15% annualized return. Now we're getting right around the hurdle I established for this fund. If it takes 5 years, that annualized return drops considerably. Same destination, very different investment. That's why I don't want to throw price targets onto the screen without considering time. So now let's look at the bull case. Suppose AI infrastructure spending continues to accelerate and Powell converts its backlog successfully. Data center orders continue to arrive and revenue and earnings compound substantially. And instead of the market compressing Powell's valuation, investors continue to give it a premium multiple. Under that scenario, I can construct a path towards something like $375 to $450 over the next several years. And at $400, we're talking about roughly doubling our money from today's price. And if that happens within 5 years, that's around a 15% annualized return. If that happens faster, obviously the return gets much better. So what does all this tell me? It tells me something slightly uncomfortable, that I love Powell more than I love Powell at 198. That's an important distinction. At 198, I don't think the valuation destroys the investment thesis. That's enough growth here that I can still make an argument for owning the stock. But I don't see a massive margin of safety. And if Powell fell towards $175, the expected return becomes more attractive. And if it fell to $160, assuming nothing changed fundamentally with the business, I'd become considerably more interested. And if the stock runs to 225 to 250 without the earnings estimates moving with it, I'm probably going to become much more patient. So I'm beginning to develop our first fund hunt buy zone. At around $198, Powell is somewhere between reasonable and I'd like a better price. But there's another stock competing for this $100,000 fund, and the valuation problem we're about to face couldn't be more different because Hyliion doesn't have Powell's earnings, and it doesn't have Powell's established commercial business, and it doesn't have anything close to Powell's certainty. What it does have is something Powell probably does not, and that's the possibility of truly asymmetric upside. And the question is whether that possibility is worth risking our money at $3.75 a share. So now let's go to the complete opposite side of the spectrum, to the 10x stock of the week, which is HYLN, HYLN stock ticker. As I'm recording this, the stock is around $3.75. And just like Powell, I'm not going to spend this chapter repeating Monday's video. We already went through what it develops, which is KARNOs. And if you missed the video, go back to Monday's video and watch the video, Monday stock hunt on Hyliion. So we already talked about the Navy, and we already talked about looking at the potential commercial opportunities. We already established why Hyliion could potentially have enormous upside if the technology works. And that's why it made it to the fund hunt. But now I'm putting actual hypothetical money on the table. And suddenly the question becomes much more difficult. At roughly $3.75, Hyliion has an equity value somewhere around $670 million market cap, depending on where the stock is trading and when you're watching this. But against that, the company finished its latest quarter with approximately $132 in cash and investments. And that's important because, unlike Powell, I'm not trying to determine whether Hyliion deserves 25 times earnings or even 30 or 40. Hyliion doesn't have the commercial earnings base necessary to value it that way. So I'm really buying something else, and I'm buying on probability. I'm paying roughly $3.75 for the probability that KARNO makes the transition from an extremely interesting technology to an actual commercial business. And that's a huge distinction, as Hyliion currently expects around $15 million in 2026 revenue. But that doesn't mean we suddenly have a $15 million commercial KARNO business. A meaningful portion of today's revenue is tied to development and validation work, and the investment thesis requires something much bigger. I need commercial customers, I need deployments and orders, we need production, and eventually they're going to have to repeat revenue. So here's what I think of the $3.75 price. The market's not valuing Hyliion based on what the company earns today. It's valuing Hyliion based on what investors believe it might earn tomorrow. And that's where this becomes dangerous. But it's also where it becomes interesting, because Hyliion still has substantial cash position. Management currently expects net cash use of roughly $30 to $35 million in 2026, as you see here. So we're now looking at a company that appears to need financing next Tuesday just to keep the lights on. And that gives Hyliion something incredibly valuable at this stage. And that is time. Time to get early systems into the field, and time to prove reliability, time to turn customer interest into orders, time to improve manufacturing, and time to prove that KARNO can become more than a fascinating engineering project. But cash only buys time. It doesn't guarantee success. And that's why I don't want anyone looking at $3.75 and thinking it's only a $4 stock. How much could I lose? And the answer is a lot. Stock price got nothing to do with something this cheap. A $4 stock can be wildly expensive, and a $400 stock can be cheap. What matters is what you're paying relative to the valuation of the business that you're getting. And in Hyliion's case, I'm paying hundreds of millions of dollars for a business whose commercial future is still largely ahead of it. So I need the upside to be ginormous. Fortunately, it could be. But now we have to deal with the hardest part of investing in a company like this. What are the actual odds that it's going to work? So this is going to be the chapter that matters most for Hyliion, because Monday we asked, could Hyliion potentially 10x from its current price, which was around $4? And I think there's a scenario where the answer is yes. But that's completely different from saying Hyliion is going to 10x. So instead of starting with a $40 stock price and working backwards, I want to think about several possible futures. And the first is one nobody's talking about, and that's going to be failure. KARNO works technically, but never becomes a meaningful commercial product. Maybe customers like the technology, but don't want to be early adopters. Maybe manufacturing proves harder than expected. Maybe reliability in real world deployments isn't good enough. And maybe competing technologies are going to improve. Maybe commercialization simply takes too long. Or maybe it's just too expensive. In that scenario, Hyliion continues consuming cash without developing a meaningful recurring commercial business. And if that happens, I don't think $3.75 protects us. This stock could have absolutely traded below $2, potentially considerably lower depending on what goes wrong. And that's why this can never be treated like a core position today. So now let's move to the next level, which is the niche success. This is an outcome I think investors sometimes overlook. KARNO doesn't have to completely fail, and it doesn't have to conquer the world. There's a middle ground, and maybe the technology works extremely well for military applications, and maybe it works in remote locations. Maybe specialized industrial customers adopt it, but maybe HYLN develops a legitimate business. But KARNO never becomes a major solution for AI data centers or distributed power. In that scenario, perhaps we're looking at something around $4 to $7 over time. And HYLN survives and the technology has value, but we don't get the enormous payoff that we're hoping for. And then we get to the outcome that I'm really interested in, which is commercial success. This is where the thesis begins to work. Early deployments perform. Customer interest becomes binding orders. Manufacturing expands. Revenue begins growing rapidly from an extremely small base. And most importantly, customers come back for more. And if HYLN can reach that stage, the way the market values this company could change dramatically. And at that point, something like $10 to $20 becomes conceivable depending on how large the business becomes and how quickly it grows. And then there's the fourth scenario, which is breakout. That is the scenario behind Monday's 10x thesis. As KARNO doesn't just find customers, it becomes a meaningful distributed power platform. Data centers need power faster than the grid can deliver it. Defense applications expand. Industrial customers adopt the technology. Hyliion successfully scales manufacturing, and multiple KARNO modules begin being deployed together into larger power installations. And now we're talking about a completely different company. Under a genuine breakout scenario, I can construct a path towards $30 to $40 or potentially even higher over the long term. But here's the mistake I don't want to make. I can't value Hyliion as though the breakout scenario is guaranteed, as it's not. The entire investment comes down to the probability I assign to these outcomes. And I don't want to pretend I can say that there's exactly a 17.4% chance of this happening, because that's a fake precision. But I can say this: I believe there's a meaningful probability that Hyliion never reaches the scale required to justify the bull case. I believe the potential reward, if it does succeed, is dramatically larger than the amount we're risking at today's valuation. And that's what makes it interesting. And that's what makes position sizing so important. Because if I put 10% of the fund into Hyliion, I'm making a massive bet on an unproven commercial outcome. And I don't want to do that. But if I put 1% into Hyliion, and now the math changes, and a complete failure costs approximately 1% of the fund. A 3x turns that position into roughly 3%. A 5x turns it into roughly 5%. And if the original 10x thesis actually plays out, a $1,000 position becomes roughly $10,000. That's why I don't need to know with certainty that Hyliion succeeds. I need to know whether the combination of price, probability, potential payoff, and position size creates an attractive expected outcome. And now we have enough information to do something we couldn't do Monday or Wednesday, and that's put these companies directly against each other, not as businesses, not as technologies, but as investments. POWL at $198.11, Hyliion at $3.75 in cash, and in the next chapter, all three finally go onto the fund hunt scoreboard. All right, so now we can finally put POWL and Hyliion side by side. But remember what we're scoring here. It's not the AI factory score, and it's not the Monday 10x stock score. This is the fund hunt score. And we're asking one question: which investment deserves the next dollar of this $100,000 hypothetical portfolio? And when I score these two companies using the fund hunt framework, something interesting happens. First, let's start with the business quality of both companies. POWL gets a 9.0 and Hyliion gets a 5.5. That's not an insult to Hyliion. They're simply at completely different stages. POWL has an established commercial business, and Hyliion is still trying to prove that KARNO can become one. So POWL wins that category easily. Next, you have growth opportunity. POWL gets an 8.5. There's clearly a major electrical infrastructure opportunity ahead, especially with data centers. But Hyliion gets a 9.5. Why? Because if you're starting from almost nothing commercially, the percentage growth can become enormous if the product succeeds. Now we have financial strength of both companies, as POWL gets a 9.0 and Hyliion gets a 7.5. Hyliion's cash position gives it runway, which is one of the things I like about the setup, but it's still consuming cash. Powell is operating from a much stronger financial position. And for competitive advantage, Powell gets an 8.5 and Hyliion gets a 9. 8.5 and an 8. Sorry. KARNO could eventually prove to be extremely differentiated, but I don't want to give Hyliion full credit for a competitive moat before the commercial market proves that customers actually value that differentiation. And then we get to the category that hurts Powell, and that is valuation. Powell gets a 6.5, where Hyliion gets a 7. Powell gets a 6.5, not because I think the stock is outrageously expensive, but at approximately $198, we're not getting much of a margin of safety. Hyliion gets a 7.0. Again, don't confuse the $3.75 share price with being cheap. We're still paying hundreds of millions of dollars for a company whose commercial future remains uncertain. Then comes the upside, as Powell gets to 7.5 and Hyliion gets a 10, as seen here. If KARNO becomes what Hyliion believes it can become, there is simply far more potential upside from today's valuation. Then we have to balance that with the risk. And for catalysts, I've got 8.5 and a 9 for Hyliion. And finally, risk versus reward, Powell gets a 7.5 as Hyliion gets a 7, which that may surprise you. Hyliion has much greater potential upside, but the probability of something going wrong is also dramatically higher. Put everything together, and I give Powell an 8.2 out of 10, and Hyliion gets a 7.9 out of 10. That's close, but those scores don't mean I should put the same amount of money into both companies. In fact, I would not. Because fund score and position size are two different things. Powell score is driven by quality, financial strength, and more established business. Hyliion score is driven heavily by potential upside. And that means these companies would play completely different roles in the fund. But there's still one competitor that we have not scored. That is cash. And cash doesn't have 10x upside, and it doesn't have growing backlog, and it doesn't have Carnos. But cash has something both of these companies do not. That's optionality. And if Powell falls to 175, cash allows me to buy it. And if Hyliion falls to $3 without the thesis changing, cash allows me to buy it more cheaply. If money produces a company I like better than both of these, cash lets me buy that instead. So Powell doesn't have to beat Hyliion, and Hyliion doesn't have to beat Powell. They both have to beat doing nothing. And the easiest way to determine that is to ask a very simple question. At what price would I become excited to buy each one? Now, this might become my favorite part of the fund hunt, because we're going to create something for every company that enters this competition. First, you got the buy zone. Not a price target, a buy zone, and there's a big difference. The price target asks, where could the stock eventually go? And the buy zone asks, at what price am I being compensated enough for the risk that I'm taking? First, we're going to start with Powell. It's currently around $198.11. Based on the scenarios we just talked through, I would divide Powell into roughly 4 zones. If Powell falls below $175 and nothing has changed fundamentally with the business, I'm getting very interested. That's where I'd call it my strong buy zone. Not because $174 magically makes Powell cheap, but because the combination of quality, growth, and potential return starts becoming much more attractive. From roughly $175 to $200, I'm comfortable calling Powell a buy or accumulate. And that's where we are right now. We're near the top of that range. So I don't think $198 is a screaming bargain, but I also don't think it's expensive enough that I have to walk away. Between roughly $200 to $225, I become more selective. I need earnings expectations to continue moving higher to justify paying more. And above approximately $225, I'm going to wait for more growth. Or I'm going to wait, not because Powell suddenly becomes a bad company, because the expected return begins shrinking unless the underlying earnings opportunity expands with the stock price. Now let's do the same thing with Hyliion. And remember, these ranges need to be much more conservative because this is a speculative company. Below approximately $3, I think Hyliion becomes extremely interesting as a speculative position, assuming nothing has happened to damage the KARNO thesis, and that would be the strong buy. From approximately $3 to $4, I think the asymmetric setup remains attractive enough to consider a small position. And that's exactly where the stock sits today at $3.75. From $4 to $6, I'm becoming more demanding. At that point, I want more commercial evidence and I want deployments. I want orders. I want proof that this is moving beyond validation. And above approximately $6, I don't want to keep paying increasingly higher prices for the same promise. I want the company to earn that valuation through commercial results. And that's a role I think will protect us through this series. As the stock price rises, the evidence requirement rises with it. And the opposite can also be true. If the stock fails or if it falls while underlying thesis improves, the investment can actually become more attractive. And that's why I'm never going to say POWL is a buy, period, or Hyliion is a buy, period. The complete statement's got to be POWL is attractive at this valuation given these assumptions, or Hyliion is attractive at this valuation given this level of risk. Because the price changes the answer, and POWL at $160 is not the same investment as POWL at $250, and Hyliion at $2.50 is not the same investment as Hyliion at $8. Same company, same technology, same management, completely different potential returns. And right now, both stocks are actually sitting inside ranges where I can make an argument for owning them. POWL is around 198, near the upper end of my buy accumulate range, and Hyliion's around 375 inside my speculative buy range, which means cash hasn't eliminated either one. So now I got to make a decision. Do I buy POWL, buy Hyliion? Do I buy both? And if I do, how much of the $100,000 hypothetical fund am I actually willing to risk? And that's what we're going to decide next. All right, so we've done the work. We've looked at the valuations, and we've looked at potential returns. We've looked at downside, and we've looked at probability. We've established our buy zones, and we've given both companies a fund hunt score. Now we got to make a decision. And I'm buying both, but not even remotely in equal amounts. Let's start with POWL. At approximately $198, I'm willing to put 5% of that hypothetical $100,000 fund into Powell Industries, and that's $5,000. I'm classifying POWL as a growth position, and its fund hunt score is at 8.2 out of 10, and my conviction is high. Why not a 10% position? Because price still matters, and I think POWL is an excellent business, and I think the electrical infrastructure opportunity is significant. I think there is a credible path towards the type of long-term return that we're looking for. But at roughly $198, we're near the end or the upper end of the buy accumulate range we established. So I don't want to use all my POWL capital immediately. I'm starting with 5%. And if POWL eventually falls below approximately $175 without anything changing fundamentally with the business, I'd have the ability to increase that position. And that's where cash becomes valuable. And now let's go to Hyliion. And this is where position sizing becomes incredibly important. At approximately 375, I'm willing to put 1% of the fund into Hyliion, and that's $1,000. Hyliion receives a fund hunt score of 7.9 out of 10. I'm classifying it as a speculative buy at the moment, and my conviction is medium. Notice something. Hyliion has dramatically more potential upside than POWL, but I'm putting 5 times more money into POWL, and that isn't a contradiction. That's risk management. POWL doesn't need to become a 10x for this investment to work. If POWL compounds at approximately 15% annually over several years, I'm perfectly happy. Hyliion is different. I'm accepting a much greater probability that something goes wrong, so I need a much greater potential payoff. and I'm controlling the risk through position size. And if Hyliion's thesis completely fails and the investment eventually goes to zero, the maximum damage for our initial position is approximately 1% of the portfolio, which can be painful but also survivable. And if KARNO becomes commercially successful and Hyliion becomes 3x, 5x, or potentially even 10x, that small position can become meaningful. That's exactly the kind of asymmetric setup that I want inside the speculative position portion of the fund. So after our first fund hunt, 5,000 goes to POWL and 1,000 goes to Hyliion. That leaves $94,000 in cash. That might sound incredibly conservative, which is good because this fund is brand new. And there will be another stock hunt, Monday stock hunt, and there will be another AI factory winner. There will be another Friday fund hunt. So I don't want to fill a $100,000 portfolio simply because I have to have $100,000 hypothetically available. Every dollar has to earn its way out of cash, but buying the stocks is only half the decision, because before either one enters this fund, I got to establish something else. What would make me sell? And with that, the 20-minute stock hunt fund has officially begun. We're starting with a hypothetical $100,000 portfolio, and our first position is Powell Industries, approximately $5,000, representing 5% of the fund. And our second position is Hyliion, with approximately $1,000, representing 1% of the fund. And the remaining $94,000 stays in cash. But I don't want this to become one of those portfolios where I tell you when I'm buying something, and then 6 months later, if the stock collapses, we just never talk about it again. We're going to keep score, and every purchase gets an entry price, every position gets an allocation, and every company gets a thesis. Every investment gets a checkpoint. For Powell, I'm going to be watching a few things. I want to see earnings continue supporting the valuation that we're paying. I want to see Powell successfully convert its backlog into revenue. And I want to see whether data center demand continues developing into a meaningful long-term growth engine. And if those things continue to improve, Powell stock fails. If those things continue improving and Powell stock fails, that could actually make me more interested and not less. Because remember, a falling stock doesn't automatically mean the thesis is broken. But the opposite's also true. And if Powell runs dramatically higher while earnings do not keep up, the company might still be doing great while the investment becomes less attractive. That's where we could eventually trim. And Hyliion's checkpoints are completely different. I want to see KARNO deployments, and I want to see commercial orders, and I want to see evidence that customer interest is actually converting into revenue. And I want to watch the cash position, because the entire Hyliion thesis depends on the company making the transition from technology to product to commercial business. And if that transition doesn't happen, the fact that the stock once had 10x potential does not matter. That's our thesis break rule. We're not selling something simply because the stock price falls 20%. We're not holding simply because we made a video saying that we like the stock. We're going to ask, has the reason we bought it changed? If the answer is yes, we reevaluate. If the expected returns becomes unattractive, then we reevaluate. If a better opportunity comes along and deserves the capital more, then we reevaluate, because every holding in this portfolio is going to have to continue earning its spot. And there's one more thing. We're going to benchmark this fund. From the official starting point, we're going to track our performance against both the S&P 500 and the NASDAQ 100. Because if we're going to spend all this time hunting for individual stocks, there needs to be a reason. If over time simply buying an index would have produced a better return with less work and less risk, then we need to know that. No hiding, no deleting losers, no pretending a stock was never part of the fund. Every buy, every sell, and every result, we're going to keep score. And now the weekly system's complete. And on Monday, we're going hunting for another stock that could potentially 10x. On Wednesday, we're going back inside the AI factory to find another company positioned around one of the AI's biggest constraints. And then on Friday, those companies have to come here to fund hunt, where they compete against every company we already own and against cash for the next dollar. Because finding a great company is only the beginning. The price that you pay for it matters. And the risk that you take matters, and the amount of money that you put behind it matters. And ultimately, the return is what matters. So if you want to follow this fund from the beginning, make sure to like the video and subscribe to 20-Minute Stock Hunt. And if you want notes and deeper research behind these companies, check out AI Factory and the Stock Hunt Insider on buymeacoffee.com. Thanks for watching, and we'll see you in the next one.